Hi everyone, this is Craig the Options Linebacker, and this is the weekend report for Sunday, February 21st. Let's start out today's video by looking at the S&P 500 from the larger time frames, the monthly on the left, the weekly time frame on the right. Now, if you recall last week, what we talked about was everybody was all up in arms because the S&P was down, about 9% or so, and I'm looking at this chart saying, big deal. It's not really that much of a retracement at all. In fact, it has not lost its primary uptrend impulse wave on this. And in fact, this is not a downtrend yet on the monthly chart until we put in a lower high on the weekly chart, which we certainly have not done yet. So again, last week we talked about this weekly chart just undergoing a normal retracement, a normal pullback in an uptrend, and so far that's what it looks to be doing. The only thing that would change my mind is if we put in a lower high on the weekly chart, showing that we actually are pulling down a little bit on the monthly chart. Again, this would still be, even if it pulled down this far on the monthly chart, you would look at that and say, yep, that's still a bullish chart short term. Now longer term, we still have this higher high to lower low to deal with, and we know at some point that this monthly chart is going to put in a lower high and it's going to start working its way downward. And then we'll see whether or not that pulls in a higher low like this or keeps working its way lower. We don't know that yet, and that's going to be literally months away, so why worry about it right now? For now, the only thing I care about is seeing whether or not the weekly chart is going to put in a higher high at this point and keep working itself higher, or put in a lower high and start working down from here. Now, to answer that question, we have to go in on time frames a little bit. Let's go to the daily chart, and we'll expand this in just a minute to look at the price action alone, but let's look at these indicators and see what they're showing us. First of all, we have the Bollinger Bands just overhead, and the Bollinger Bands have always done a very, very good job on the S&P with showing where the potential price is going to hit resistance. So the price overhead could probably go a few more points, and maybe even peak outside of the bands briefly, but it's going to get pulled back in. It's made a 4 standard deviation move off the bottom, and that's one way of the band saying it's come a little bit too far, a little bit too fast, perhaps it's time to pause. Now, the other thing on this chart that we pointed out over the last few weeks is these strong bullish divergences, not only on the MACD histograms, these are textbook, but also on the stochastics as well, where we had lower lows in price on higher lows on the indicators. That was another thing that made me last week feel that this was probably going to be the low of the bounce, or the low of the correction at that point. Now let's take a look at the S&P daily chart just with the price on it. So let's just focus on the price bars and see what they're telling us. First of all, we're going to look at Fibonacci retracements, which is a form of looking at price. And you can see that after this initial move down, which was a wave-based structure, we've made one impulse move back up, and it's gone right up to that 61.8% retracement, which is sort of the final line there, kind of the Maginot line is what I call it. Now, this line up here also corresponds to some pretty heavy resistance that we had in an earlier consolidation zone, so it might be tough to get through that the first time on. Now, just looking at this price action, we have the initial move down, we have a kind of a weak bounce back up because there's very little volume behind this, and then a very strong move down punctuated by a hammer candlestick. We've seen this movie before, especially the rebound bounce off of this, which is now taken out the prior swing high. We have a pretty good example of this from 3 years ago where we had the similar thing happening. We had the initial move down, rolled over, and printed a hammer on the way down as a lower low. And then we had a very strong bounce off the bottom up here, broke out above the prior swing high, and in fact even had a massive upside day. This was a Fed meeting move, which got it up to the 76.4% retracement. Now what happened after this is that the price just sort of shuttled around for a few days, and then things got scary again, and it started heading lower. In fact, if you look at this pattern on a hard red edge, which I'll do right here, so doesn't this look like it's heading lower? We have lower highs on the daily chart, and things look to be rolling over again. This is where retail money that missed out on this whole move to the downside said, you know what, I'm going to short the next bounce back up. And this is where they all get short, And the problem with this is that they're just too late to the party. They get on board way too late, and this is where the smart money steps in and starts to buy. And so as we look at this example from 3 years ago, we had a massive rally that came off of here, and it was because that too many people got short right at this time right here, which was the wrong place to get short. They got bent over, and this causes this ballistic short covering rally that just blows up past prior highs. So going back to today, I don't know if we're ready yet or not, or whether we need one more day to the upside to get everybody too bullish in effect, and then see whether or not we have one of those scary moves to the downside that maybe walks down about 20 points in the S&Ps, gets all the retail money to go short at this level too late. They already missed the move here. That was the big move. So if they go short here, what this is going to do is create that higher low and create that short covering event and get us past that 1150 level again. It almost wouldn't surprise me to see the bigger players actually manufacture an event like this, specifically because human nature repeats over and over and over again that this is the way to get a market to move higher, is getting too many people to climb that wall of worry. Now let's finish out today's video by looking at our positions. We just closed down. This is OPEX weekend, so we just closed down our February positions. Another profitable month, 13 out of the last 15. I think we're doing pretty well. We're in a groove. And so right now we sold these positions as the price was coming down here, which was a scary move, but this is the way that they work. We have bull put spreads down here for March that the price has just run away from, and that helps doubly because the implied volatility comes out as well. So these are already very profitable. Probably could close them out just for a few cents right now. And we have the same thing going on down here with the Russell. We have some put spreads that are way out of the money and have been run away from. So we expect an easy job of maintaining and defending those the rest of the month. Now I do have some call spreads up here, which I added as the price rebounded and came up to resistance, but it's blown through that to this point. So what I did was, as the price got above 625 and got past my delta threshold, I added a synthetic stock hedge to this position to help defend this against a continued move upward. So the way I've calculated it is that I can still get knocked out of this position and adjusted and rolled back up again and still can profit for the month of March. And lastly, here's our delta neutral spread on the XSP, and we got into this trade as the implied volatility was going up like this, which is the time that you want to get into these trades, and we entered right around this level or so. So it had plenty of room to the downside, and it's got a lot of room to the upside. However, the price is pressing up against those upper strikes, and so what we had to do was we had to hedge the upper side, and we do it like this. Okay, there we go. So what we do is we add a debit spread to the calls up here, and it turns this into a form of butterfly and also helps trim off the upside risk against a sustained move to the upside. Now if we see that move that we talked about before where the price perhaps makes a jab up and then does a scary retracement back to this level, that would probably be a good time for us to, and that's going to take about a week or so for that to happen, that would be a good time for us to get out of this trade because the P&L will probably be up in this area for that point, and we can probably clear out of this trade with anywhere from a 25 to 30% return on risk, which isn't a bad return for the month. Thanks for watching, everybody. Have a great weekend.